In this video, I'm going to show you how to position size and manage risk like a market wizard. I'm going to start this off reading one of my favorite quotes from Bruce Kovner. This is from the first Market Wizards book. And Bruce said, quote, "Whenever I enter a position, I have a predetermined stop. That is the only way I can sleep. I know where I'm getting out before I get in. The position size on a trade is determined by the stop, and the stop is determined on a technical basis. For example, if the market is in the midst of a trading range, it makes no sense to put your stop within that range, since you're likely to be taken out. I always place my stop beyond some technical barrier." End quote. So what does Bruce mean by that? Here I'll go to, just because this explains it better, you could see here when the NASDAQ, for months was whipping sideways. If you're trying to buy the market and place your stop within that whipsaw action, it's likely to be taken out. But if you're setting that stop, below a higher low, it's less likely, especially if the market does go in the direction, you're predicting or you're trying to, play. And so that's all he's saying is like you're setting it beyond that trading range, like right underneath a higher low, for example, is exactly what he's talking about. And William O'Neill's no different. He's telling, he talks about with his cup with handle, he's placing the stop just below the handle area. He's not placing the stop within the handle because it's, higher chance of you getting kind of stopped out. All right, so we're going to use MU as an example here to kind of discuss everything Bruce is talking about, with an actual trade and an actual setup. And you can see it in action with the chart and how you would determine your position size. So let's first talk about, what was going on. So, the market was in this sideways kind of choppy consolidation for months. We eventually kind of started grinding down, breaking down to where price was below all key moving averages, the short term, the 50-day, and eventually broke even the 200-day. And we even, established a lower low. We had lower highs, and it was, luckily we recovered pretty quickly. But at that point, just like Paul Tudor Jones says, nothing good happens under the 200-day. And so, at that point, most of us moved to cash or we were already greatly reducing our exposure. But then the market recovered pretty strong. And at this point, you could see this powerful week that we had. We started getting above the short-term moving averages. And then on April 8th, we had a big gap up day. And we got above the 200-day and the 50-day. And so at this point, we had kind of the green light to start getting involved in the market again. And then you can kind of see the market just ran up strong, pretty much rode the 10-day all the way up until it had its highs in early June. And so going to MU, plenty of time for this setup, okay? Here's April 8th, the first dotted line, and MU got above the 50-day and its short-term moving averages. Also, MU you could see was way above its 200-day. So it held up pretty well compared to the market when the market was breaking down, during March. And then we had this handle in here. Now, we also had, as we were starting to form the handle on April 15th, the NASDAQ and the market were at all-time highs. Like they were breaking into all highs. So we have the market environment is confirming. Like we have a good environment. So that's check. Green light on the market environment. And then leader characteristics. We also were in one of the biggest names with growth fundamental characteristics that we look for in the biggest winning stocks. 756% EPS growth, 196% for sales, 67% for pre-tax margins, 39.8% for ROE. And then fund ownership was growing quarter over quarter from 1% to 8% to 12% to 26.5%. So it was accelerating too. And then also add that it was in semiconductors, which was the leading group, the highest performing group off the lows as well. And we had plenty of confirmation, not just from the initial lows, but all the way up until we had 3 weeks. So we had plenty of time to get into this name and to plan this trade. And so let's assume you wanted to buy the MU's breakout to new highs, and you were going to set your stop right below the handle. Now, how do we position size that? And that's what I'm going to show you. So we would then, you could do this on Excel. I'm sure there's plenty of other calculators, but you could also do that within the the momentum trading strategy software. Go to Trade Risk Calculator, Position Sizing tab, Trade Risk Calculator, and just put in your ticker. The price, we're going to buy it at 470. That's the breakout to new highs. The stop is right below that handle at 434. I'm going to simulate we have a $100,000 account and we want to risk 1% of that. That'll give you your shares, 27.78 shares. Tells you, shows you your stop distance is 7.66%. We're within what, William O'Neill and Minervini, a lot of them talk about. And we're, again, risking only 1%. And our total exposure, how much capital of that 100,000 we have tied up, is a little over 13,000, 13%. Okay. Now, say you wanted to have that less, you wanted only 10% exposure, go to mode B, and you just put here 10%, and it drops your shares to 21.28, and it shows we're now under 1% risk, about $700 on the trade. But say you wanted to, you've been doing well, and you want to be, you have a lot of conviction on the trade, and you've earned the right to kind of increase your exposure. Let's say you wanted to do 20% exposure. It'll raise your risk to 1.5%. You'll be exposed to $20,000, right? And you have 42 shares. But for this example, we're just going to stick with mode A, keep it simple. And so that pretty much brings us to right here from our entry with our stop below here. And I'm going to add this position sizing indicator I have from TradingView just to show you that red line is our initial stop. Green line is, where we're buying the breakout to new highs. We have the breakout on volume down here. You can see the volumes coming in, and you can see that the volume was drying up in the handle. That's the volume characteristics we like to see as well. Now, that pretty much gets us in the trade. We just did our position sizing, everything. We have a nice setup. We have all the markets supportive, and we have all the characteristics of the biggest winning stocks in history, right? Now let's say, we run up, William O'Neill talks about selling some around 20, 25, 30%. And if you're risking 7, 8%, that's about 2 to 3R, right? Around 3R wanting to sell some into strength to finance the rest of the trade. And at that point, you can either leave your stop or raise your stop to break even. And so we have the first little kind of sideways action we get is not even, slightly above 1R. So we wouldn't look to sell yet. But we kind of get this first sign of weakness here, and we're already up well above 30%. And so I'm going to say right here on May 7th, I'm going to sell some. Now, how do we do that to, keep track of our position size? Go to the trade management tool under mode A, and here it is. I'm selling, 50% at price 650 on, I put the date in May 7th, and that's, 50%, that's 13.89 shares. And let's say I put my stop to break even. And so now you see it's basically, if price comes down and hits my stop, I've already locked in 2,500 in gains, right? I'm already up 2.5R. Now let's say I leave, I don't have my stop. My trailing stop, is still 434. It'll show you remaining risk from this point is $500, right? And even if the rest of it comes down and hits my stop, I'm still at a 2R trade. And this is exactly what George Soros talks about. You want to get in a position to where you're no longer risking your principal, right? You're risking your profits. And so initially we're risking our principal. We're risking our capital. But once we get into this position where we've now sold some into strength and we're no longer risking our initial principal, we're risking our profits, we're in a much better situation. And that's what we have right here. Now let's go back to the chart here. Now price continues to run up, and then eventually it pulls back. This is the first real natural reaction. We talk about this in the course. We should be expecting this. This isn't anything to close out. We're looking to see if we find support and then move back up. And we do. We kind of break through the 10-day, but not quite go to the 20-day, and we kind of pull back up. And we have a position to add to the trade. And so we're going to add here, and we're going to raise our stop right above the higher low here. So around 650. All right, so now I'm adding not quite as much as I sold. So, I sold 13.89 shares into strength. I'm adding back about 25% of the original share, 6.95 at price 750 once price gets above that 10-day on May 21st. And I moved my stop. So I bought more at 750 and I moved my stop right below the higher low. Okay, at 650. So now you can see here, even if the rest of this goes down to my stop, I'm not risking anything anymore. And I'm at $4,300 in guaranteed profit right now. And my trade's already at 4.31R. And here's where we're at you see this blue little triangle where we're adding back, and that orange line right below that is where we're placing our stop. And then the price we get that big gap up day on volume, price runs. We get another natural reaction back towards the 20-day. We basically move back up towards new highs. Now, here's something, a lot of people are like, why didn't we add back? Well, after the June 5th, right here, this kind of big gap down below the 10-day, MU held up well, but the market, that's when we kind of had this up here, this big warning shot. This is when, you could tell, look right here at the character. We have a character change, right? This is not normal action, dropping 4%, volatility is coming in. Look at the daily price bars are much larger. Volatility has come back in. And we also started to see tech growth start to lag. We start to lose their strength. Semis were taking a hit. Computer hardware, software. A lot of the names that were leading this entire run up are now individual names are breaking down too, and the market. So even though MU is doing well, that's kind of a warning as well. So we didn't add back, and we also decided to sell some again on June 18th. Another kind of quarter of our position, we wanted to sell. So let's go back to our tool here, and we'll add that in here. All right, so we added, we sold another 6.95 shares, about 25% of our original shares that we bought on our entry at 11.25, where we showed on the chart on June 18th. And now we're looking even better. We're at 7R on the trade, and our stop is, we're going to say at least, wherever somewhere near the 20-day, we'll say like our stop is moved up to 950. And so you can see how we're kind of tracking this. Now, eventually, we're going to say here price went to new highs, but then came down, and we had our first lower low. We broke the low. We also had a couple solid closes below the 20-day, which hasn't happened this whole run up. And so we just decided to close out on July 2nd. And we see that the market has been not behaving the same way that it was on this nice uptrend. So we decide for now we're just going to exit the trade. All right, and there you go. You see that what we kind of locked in and whatnot. So that's just an example of how to use kind of the trade management tool with also our initial position sizing calculator. It also keeps you, making sure that you're not overly exposing yourself as you're adding to winners. Like I know I didn't on this trade in this example, but there are times when you can add, and you might get carried away and notice, whoa, my exposure is at 40%, And so that's why it's good to have a tool like this to be able to track, the exposure of your total account as you're adding to a big winner. All right, so as we close this out, remember, before you get into position, you have a stop. You know where you're getting out before you enter, okay? That's what Bruce is doing. You should be doing the same thing. That's what O'Neill does. That's what Minervini does. That's what every single market wizard that I talk about on the course, there's dozens of them. So you know where you're getting out before you get in. And the position size on the trade is determined by the stop, right? So where your stop, you have to figure out where's a logical stop first. Then your position size will increase or decrease to get you to how much you want to risk on your total portfolio, the 1%, 2%, 0.5%, whatever, okay? And remember, it makes no sense to be putting stops in the midst of a range just because. And really what he's saying is people that are just blindly doing an 8% stop, and then the 8% stop doesn't get them below the right below the technical level. It's placing it inside the range of the price bars, okay? We're not doing that. So I hope that kind of clears it up and explains. If you have any questions, please reach out and let me know. And if you want to go deeper into this, take a glance at Module 5. In Module 6, I believe, I kind of give more examples with other setups on logical areas to place stops, how to manage the trade with different trailing stop techniques, and just how to manage risk and whatnot. So hope that helps. Let me know if you have any questions. Take care.